Good morning, everyone. This is Audrey Boysenell, Mortgage Pros 411 with my buddy, Kevin Casey. And today we are joined by the lovely Julienne Joseph. How are you today, Julienne?
I'm wonderful. Hey, guys.
So good to have you back again.
Thank you. This is number 3, I think. I think this is my third
Yeah.
time with you guys.
Is it? Oh my
And,
God.
and each time you have a different title.
And
Yeah.
I always have different hair. So this is I have different hair every time we talk.
You know what it is? You are very adaptable, very, very good for the mortgage industry. Adaptable. You can roll
That's it.
switches, you can change, you can do different. It's great. Okay,
I
so
love it.
dive in. It's Jobs Week. Did you know that, Kevin? Jobs Week.
Jobs Week?
So today, Jolts. Jolts came in $400,000 for help. The 400,000 extra jobs, more than last month. And
Wait. 400,000?
yeah, 300,000 of them, by the way, were leisure and hospitality, which is very interesting. So 7.8 million job openings. Hang on. 5.5 million hires. That the hire rate fell from 3.5 to 3.4, and 5.2 million separations, not just 5.2. Anyway, so people losing their jobs. So again, taking longer to get hired once you lose your job, but and again, we know that with Jolts, first of all, BLS produces it. That's always questionable in my mind. But also, it could be double postings. It could be, we don't even know if the jobs are real. So,
Well, first of all, 250,000 jobs created in a month is a good report. 400,000 jobs created in a month is spectacular.
They're not a job.
Everybody is saying the opposite.
Nope. You've got it wrong. These are not job creations. These are job openings.
Same
Job
difference.
openings and labor turnover. That's what JOLT stands for. So that's
Okay.
tomorrow. You're
That's still
yourself.
that's a lot of jobs. Now, is that because Trump is having all the people that work in hospitality deported?
Okay. We are not going there, young man. I'm going to put you in timeout. Good God. All right. So one more time, kids, don't listen to any of that. That was nonsense. Okay, it's gonna be a long. Julienne, you and I are gonna have a nice little chat. Okay, Kevin, you're in timeout. So just a reminder that we have Friday. We're closed because it is what? 4th of July.
4th of July.
And so we know everything will shut down way early on Thursday. So we basically have 3.5 days of work this week, and we're already through most of it. So
yes,
take
actually only have 2
off,
days left.
kids. Okay, but if you are working, you might be interested to know that tomorrow there are more reports. Mortgage applications and ADP is coming out. They are expecting 95,000 jobs created. And Friday, the markets are closed. Thursday, we have BLS. It'll be on Thursday instead of Friday. Okay, so we know
Wait, back up. So you're saying they're expecting 95,000 jobs created.
ADP. Now
ADP.
BLS.
ADP. Okay. So that's opposed to the 400,000 jobs openings.
Oh my God. Okay, just pipe down. I thought you were in timeout. What are you talking? Okay, let me just get through this
I'm
part.
just trying to make sense of these numbers because they don't make any sense at all.
None of it's gonna make sense. I even hesitated, like, do I bother? Like, what's the point? Like, I'm gonna talk about what the expectation for BLS comes in at. Who cares? Because it'll come in totally different. And then they're gonna revise it next month, then revise it again the month after, and then the QCEW is gonna come out and it's gonna blow it all away. Since we had they were off by, oh, what was it again?
800,000, 900,000 last time, yeah.
A million last year, those ding dongs. So anyway, just for shits and giggles, BLS is supposed to have 110,000 job creations, and the unemployment rate is supposed to go from up to 4.3 from 4.2. Poof, got to go back. I'm trying not to go backwards. Okay.
Wait.
All right,
What's that number supposed to be? 3.9?
Okay. How do I, is there a way
I'm trying to write these things down. You say them so quickly. I'm not the only one. Our audience is probably trying to write these numbers down.
Okay,
too.
I want to hear from the audience if they're having trouble keeping up or if he's the only one. Okay, so currently have an unemployment rate of 4.2%. They are expecting that on Friday, with the BLS jobs report, that the unemployment rate will move up to 4.3. Now there are decimals and rounding up, rounding down. There's all sorts of nonsense going on. And we also know that those numbers are total bupkis. However, they do move the market. So it is important to actually have some sense of what the hell that's going to be all about.
So when they announced the 4.3, should we have locked the day before or have floated? That's the ultimate question.
That really is. So we will go back. Let's just share with
I'm
Julienne.
going to float because the 4.3 would mean the economy is slowing and therefore rates are going to get better. And therefore, I think the market bond rates will drop. That's my thing.
Julia, we have a little ditty that we like to sing here. If you see it,
Okay.
like lock it in. That's it. It's very short.
Yes,
Anyway, so
I like it. It's
I
catchy.
I would be careful with this market. Okay. So I also just want to issue a warning. I am in a place with 19 of my closest relatives. I'm actually missing a couple brothers and their families, but there are a lot of people where I am. And that door behind me keeps opening. I don't think there's any way to stop it. Kevin, I've seen my mom, my dad, two brothers, no, yeah, two brothers, countless nephews and nieces, and I've been sitting here for an hour. So God knows what's going to happen behind me. Apologies ahead of time.
As long as you don't do a repeat like you did in Italy, where someone walked behind you in their briefs and tank top, that was.
Forgot about that. Oh God, that's right. Anyway, okay. So with all that being said, don't know what you're going to get, but so far so good on the Wi-Fi because it is crap where I am. I mean, total and complete garbage. So this is a miracle, really. Um, okay, so there you go. So it is jobs week. We don't know if it's going to matter in the long run, but it is what it is. Just a reminder, we're part of the Chrisman commentary. They now have a Chrisman marketplace. And so there are job openings and you can go there if you need a job, if you want to post a job, and then all sorts of other information. It sounds like it's continues to develop. So it's becoming a really good resource for the industry. And then also I thought it was interesting because Rob had a whole conversation about the CFPB in his commentary on Saturday. And he mentioned that they are still, even though they've been kneecapped in so many ways, they're still going after bad guys. So that's not a bad thing. That's a good thing. Okay, so Julienne, let's just talk about you for a minute, shall we? So,
Hey.
one, to say that we botched the title this week is a massive understatement. Julienne was not the position that was in the title. And, and although there may or may not have been a texted argument happening between two continents, it did not get corrected. So, with all that being said, why don't you walk us through? Because we knew you when you were working with FHA. So why don't
Yes.
you walk through the fact, like, let's talk about the fact that you were an LO, which I love that you're
Yes.
an LO because you have some sense of what our jobs are like, right? You know what we're
I
dealing
I
with.
absolutely do. This is my favorite support group on earth. Loan
Yeah,
Officers Unite, Anonymous, whatever we want to call it.
exactly.
Yes.
Exactly. So and then you did what? Tell us what happened
Oh
after.
gosh. Okay, so I originated and I started off actually as a loan officer assistant. So I started off taking the application. So this was
Way
the
back.
NMLS days. This is when, a loan officer just needed bodies in order to go get applications. So I started off as an LO assistant. And then, of course, I decided to, spread my wings and originate myself. And
Yep.
then, here comes the housing crisis. And I knew, of course, everybody knows that was just doomsday for us. But I knew that I still wanted to be involved in housing. So I went to the Neighborhood Housing Services of Baltimore right after the housing crisis. And I was a foreclosure counselor in Baltimore, which was like ground zero. It was crazy, but I say that is absolutely where I earned my stripes. And there's no way in this world I could have served in the capacity I did at HUD had I not had that experience at the Neighborhood Housing Services of Baltimore. So shout out to my housing counselor folks. And then after that, I was at the Virginia Department of Housing and Community Development, where I ran the Neighborhood Stabilization Program, NSP, that, some of you guys may be familiar that, they took distressed properties and made sure that we used federal funds in order to get them back on the market for first-time home buyers. Then I ran the Affordable and Special Needs Multifamily Housing Program for the state of Virginia. And then I came to DC, where I was working at the Mortgage Bankers Association in their residential policy shop. and I was the associate director of government housing programs there, where I just completely went nuts on student loan debt calculation, which was my baby, which I worked on for 3 years in order for us to make it be a sensible piece of policy. So that's the torch that I carried for like 3 years while I was at NBA. And I believe that's what got the attention of the Biden-Harris administration and Secretary Fudge. And I was asked, brings us to where Audrey started, asked me to start the story, where I was the Deputy Assistant Secretary for Single Family Housing in FHA. And I was in that role for 18 months. And then Secretary Fudge promoted me to be her senior advisor for homeownership. And I was in that role for about 6 months. And then she asked me to be the chief of staff at HUD. And I was her chief for her final year of her tenure in her cabinet seat. And then after she retired from public service, I was the chief advisor to the acting secretary, Adrian Todman. So that was my journey. And today I'm the founder and principal of JYJ Consulting. And that's where I am today.
Oh my God, what a journey, right?
The journey, it's a lot.
Wow.
So,
Yeah.
yeah, so no wonder we couldn't get the title right.
It's a lot. And
It wasn't my fault, Audrey.
I told them guys before we got started that they just need to make me a symbol like Prince, and I'll just like the policy person formerly known as, and then just make me a symbol.
Exactly. Well, you picked
Maybe a house key or something. I don't know.
Exactly. So, okay, so you are now consulting for the
Yeah.
industry, which tell us what that looks like.
Yeah, so just all things residential housing finance policy. I'm working with mortgage companies, nonprofit organizations, academic institutions, mission-driven organizations who are focused on expanding access to homeownership, and also kind of being the mortgage whisperer. There's a lot of transition. Of course, things are very fluid right now. And being that I've sat in so many seats within the building and understanding how the sausage is made, a lot of folks are reaching out to me just to kind of have a bit of a coach, through this moment of transition, and just to make sure that, if there are certain things that they need to be advocating for, or certain stands that they need to be making, or recommendations that they need to be making, I provide that level of support to different types of organizations, and also giving speeches too about best practices of what we learned during the course of the pandemic, and just how we were able to save 2.5 million homes during the course of the pandemic.
That's amazing.
So we just talking about all of the work that we did, and just hopefully sharing with the industry things to hold on to make sure that we keep everything sovereign. That's the goal.
Oh, there we go. I love you. Get out.
I got a fire truck outside, so it's okay, and I got a dog that wants me to throw a toy. It's a lot going on.
I know. Okay, so why don't we back up for a minute, because there is some confusion around the difference between FHA and HUD. Do you want to walk us through that for a moment?
Yeah, absolutely. So HUD, of course, is the overall federal agency that the U.S. Department of Housing and Urban Development, that basically covers everything from soup to nuts that the federal government provides, whether it's from rental assistance, Section 8 housing, disaster and recovery funding, providing enforcement for fair housing, providing support for public housing associations, PHAs, all of those things. That is what HUD does. So HUD is the overall agency that provides all the federal support.
Does FEMA report to HUD?
Oh, say it again.
Does FEMA report into HUD?
No, FEMA
Okay.
is its own agency. Yeah. So, and FHA, however, is the actual insurance agency for the federal wing. So that's the Federal Housing Administration. So a lot of times people think that FHA is an actual lender and things like that, but FHA is actually the largest insurance company in the country because it insures, mortgages. So that's the difference. And one day we can talk about the difference between, Fannie and Freddie and how FHA is different, but just understand that that in essence, FHA is the mortgage insurance company for federal mortgages.
You were the person that taught us
Yes.
years ago, and I don't think most of us knew that ahead of that. It was interesting. So, and you were also it was interesting back then talking to you. I mean, we were really excited about the things that were happening at FHA, and all the way up to when we spoke to Julia Gordon, I think last November, like as she was, knowing that she was going to be leaving. So anyway, there was a lot of things that were done during that time period. And yes, people were kept in their houses. And that really has paid off in the end. There was no housing crisis. Most of the people were able to get themselves out of forbearance. All of that really, really worked well. And we've heard this both from people at the CFPB and other regulatory agencies that those lessons that were learned during the meltdown were really put to good use during lockdown and COVID, and less people lost their houses than they would have otherwise. So,
Yeah.
yay. Okay, so with FHA right now, how much insight do you have into what's going on over there and what's happening with the current group of people that are in there?
Yeah, well, of course, and shout out to all of the career folks who are still there at HUD. One of the things that I say is that they are, in essence, the machine is designed to operate with continuity because
Yeah,
of the professionals and the institutional knowledge that career staff provide. So
Mhm.
shout out to all of my career folks that are there. I mean, of course, there's still access to some folks who are there who, whether it's through communication with me or whether it's through communication with other trade organizations and partners, it's necessary. And I think that, some folks reach out just because, I did create 29 pieces of policy while I was in seat. So if there are questions about implementation of things, some folks may say, when we did this, do you remember how we got to that point, or what did we lean on? What was some of the, evidence of the data that we used in order to do those things? So yes, so still have communication with some of the staff folks that are there. But it's necessary because, the
yeah,
one thing that I know is that it was beneficial to me to be able to reach out, and have conversations with my predecessor and other people who were in 45, because, you don't know what you don't know.
yeah.
So to be able to have that ability to pick up the phone and call the last person who was there to say, where did you leave? I don't know, the key to this is important, to be able to have that communication.
Yeah, it
That's
definitely
great.
is. So they didn't experience the same cuts that CFPB did they?
So of course there are proposed cuts, not only programmatically, but also to the staff. And I think, that there are conversations about 44% of the FHA staff, of course, being cut. I think that that is still under consideration. And I think that, we just have to wait and see what that looks like. There have been significant cuts there. I do know that at the agency. But we're just waiting to see kind of where the dust settles, if the majority of those cuts have already been done, or if there are going to be additional cuts made to the FHA program. So I think we're all just kind of waiting to see.
Oh,
Wow.
wow. Okay. 44%. How do you manage that? Like,
Yeah.
yeah, wow. Okay. Wow.
Yeah.
Moving right along. Um,
Well,
there
you're in the Washington DC area. How are cuts being affected? Are there lots of people out of jobs in the area?
There are. I mean, and I think too, some folks had long-term plans of retiring, actually
Uh-huh.
in federal service. And it's not just HUD, it's across the
Right.
board. There have been significant cuts there. But I think that, to the point of we're talking about the available jobs, the largest employer in the country is the federal government. So I think, particularly here in the area, a lot of folks were not planning to have to dust off resumes that they probably haven't used in 20 years, not
Right.
knowing that, the day would require that. So, yes, I mean, people are actively trying to figure out how to transfer a lot of the skills that they have acquired during their time at HUD to do something else. And it's one thing when you plan a transition from a federal agency, but kind of being forced to have to do so is leaving a lot of people trying to, build the plane while they're flying it.
oh,
Yeah.
interesting.
So you knew your cut was coming, most likely.
Yes. Well, yes, because as a political appointee, of course, we serve at the pleasure of the president. So there
Right.
was no surprise that we would not be serving at the pleasure of President Trump. So
Right.
we kind of knew that it was, once the election, after election day, that we would probably have to vacate near or before January 20th. of this year.
Although there have been presidents who have kept, even though they've changed Democrat to Republic, they've kept some political appointees over the years.
Yes, there have been times, as a matter of fact, when we came in under President Biden and Vice President Harris's administration, Brian Montgomery was very instrumental in the transition and stayed on, I think, close to 6 months. While that seat, as far as the FHA commissioner and I believe the deputy secretary role was being filled by Adrian Todman, I believe that he stayed on to help with that transition.
Mhm.
But of course, the prerogative of the president and the administration, if they choose to do that, of course.
Yeah.
Right. So there were some changes that were rolled out last Friday having to do with flood insurance, et cetera, with FHA. Are those things that you could speak to? I mean, those changes that have happened or are happening?
Yes. So I will say this, that that there is a desire for streamlining of processes and making sure that that money gets out the door easily. And I think that is the motivation behind a lot of the changes that we're seeing being made. I would caution, just in general, particularly with things dealing with climate and flood, that you all are very, pay attention to those things that may be taking place. And if you do have concerns, make those concerns known, write letters, because again, every mortgagee letter says at the bottom of it, if you would like to provide feedback, do so. I think that it would be, it would be in the best interest of everybody in the industry as these particular rollouts happen or rescissions happen, that you all, if you feel something that needs some clarification, then definitely reach out, because we absolutely did that. One thing that we wanted to do whenever we rolled out policy or if we retracted anything is that before doing that, we wanted to have conversations with industry to make sure that there weren't any shocks to the system. So that way, if anything did change, then we wanted to make sure that, industry came along with us. And then if we needed to kind of massage things as we went along, then great, but we didn't want to cause anything that would be a shock to the system. But if in situations where kind of things might drop, if you find out after the fact that, you need some clarity, then I would encourage you all to reach out to, to the leadership over at FHA to get some.
I think for all of us, we will all need to be continually aware of all of the climate related issues that are happening across the country. And there is often this idea that, oh, it's just fires and earthquakes in California and hurricanes in Florida. And that's not the case. It is literally, when I hear about flooding in Vermont and hailstorms here that decimated this and
Tornadoes there.
it is all
They're
over.
becoming more violent. And let's just be like thunderstorms, 15 years ago are not the thunderstorms that we're seeing today. I mean, I'm seeing more bark stripped off of trees that are not hurricanes than I've ever seen before, which is kind of crazy. Wow. But the one thing that we're very proud of before we transitioned out is that we got permanent authorization for our disaster recovery funds. And that was a huge win for the agency, because before that, even though we had funds appropriated for disaster, anytime there was a nationally declared emergency, we would still have to go to Congress in order to get permission to spend said money. So FEMA would go out, make their assessment of what they wanted to basically provide in assistance and help. And then we would have to wait, but then after their assessment, go to Congress and say, hey, can we actually tap into the kitty to meet the unmet need of that particular area after a disaster? But during the continuing resolution at the beginning of the year, luckily we were able to get permanent authorization before transitioning out to help the money get to the communities faster. So HUD no longer has to go to Congress in order to send relief funds after a national emergency once FEMA has hit the ground. So that was a huge win, at least for now, for the funds that are available to get them, especially with us being in hurricane season right now.
So can you walk us through how our clients would access that? I mean, how does that work for our clients? For somebody who has an FHA loan, what would they do if there's a disaster to use this money or access money?
So usually disaster recovery money is meant for some type of public good. So not necessarily for an individual private owner. So, but that is for, the redevelopment of, let's say, hospitals, or if they're redevelopments of shopping centers or things like that. If there are disaster recovery funds for the public good, then that's what the recovery funds are typically for. Or we would provide them to state and local government for them to then administer the funds. But of course, on a FHA mortgage, for example, flood insurance would cover that. For example, if flood or hurricane was an issue for the destruction of property, the personal insurance with the private insurance would actually protect the homeowner. But disaster recovery is more for infrastructure and the redevelopment of buildings for the public good.
So it really has nothing to do with who has an FHA loan at all, and more to do with, so like in the Pacific Palisades fire, do you go in, do they get some of this money and they go build whatever needs to be built?
So perfect example, like in Hawaii, when we had the wildfires, like we provided funding. So it didn't necessarily go to the individuals who need to rebuild houses because hazard insurance would cover the rebuilding of that. But let's say, for example, it was a multifamily housing project, for example, that had a public good element to it. Then of course we could use disaster recovery that would be under, CDBG or home money that may be disaster recovery funds. And then we could utilize it by distributing those funds to state and local government for them to administer it for the benefit for infrastructure, roads, those types of things. We could use it for that, right?
I didn't know.
Exactly what I was gonna ask.
Did you know about this? I didn't know about this.
Yeah, so you can look up disaster recovery funds at HUD. Yep. So, but the key is that we have to go in after FEMA has already made their assessment, of course, because they are the first line of defense for recovery and assistance.
All right, well, that's good to know. Good grief. Okay, so let's see, what else do we want to talk about? Oh, I saw this note in your notes. FHA's buy now, pay later. Can you explain that? I don't know what that is.
Yes. So there's there's a new RFI that's out, and I would recommend that everybody on this call go take a look at it. Or request for information. Sorry.
There you go.
In the government, we do alphabet soup, guys. So anytime I give you an acronym, please stop me.
Usually into alphabet soup police, but
Yes. So request for information. So an RFI is usually just kind of a fact-finding mission that an agency does when they're interested in creating a framework for a particular piece of policy. Earlier this week, I believe it was this week. The days just run together. Like, I don't even know. Like, I just can't believe we're already at 4th of July. But it was either earlier this week or late last week that FHA just published a request for information about buy now, pay later. So a buy now, pay later, for example, is I want to go to Beyonce's Cowboy Carter concert and it's a $600 ticket and I don't have $600 now, but I'll do something like Klarna. Or I'll do something like a pay in 4 with PayPal or something like that. And every 2 weeks, I'll send X. And then, in 3 months, it'll be paid
buy now. I thought it was an FHA buy now, pay later.
No. Buy now, pay later is literally our modern day layaway, except you get the stuff up front.
Now it's going to show on your credit report.
Yeah, we talked about it last week. They're now going to show on your credit report. So that's a biggie.
So the question now for FHA is, okay, do you underwrite buy now, pay later loans? And this is one of the things, and how I talk to you guys that I'm consulting, for a lot of organizations right now. And this is one of the things that I'm providing a little bit of insight and thought about. It's interesting because the average buy now, pay later loan is somewhere between $100 and $300. Like, nobody's doing buy now, pay later for 10 grand. Like, it's not like that. But maybe the most might be $1,000, maybe $1,500, but people are paying bi-weekly on it, or maybe once a month and pay it off in 12 months. But they usually don't go beyond 6 to 8 months on whatever they're paying off. So the thing about it is, do you account for a short-term debt on a 30-year mortgage when we're looking at somebody's ability to repay, when we know that these are lower dollar obligations that they're doing? So that's kind of what the thoughts that I'm sharing with a lot of organizations and creating their response to these RFIs is to say, is it alarming? Because if one loan, okay, not a problem, but if somebody has 6, okay, maybe there's an issue. You know what I mean? Or is there some tea leaves to read that somebody's in financial hardship because they're doing so many temporary loans for small stuff? So just kind of crafting, again, scaffold, not hatchet, and just to make sure that this is not creating a fire that is not necessary, but making sure that there are some sensible responses so we don't just like jump out the window on these. So just helping folks craft that. But that's what the buy now, pay later.
Okay.
And it's not always people that can't afford things that use them. I knew someone, and they would always treat themselves like once or twice a year to something
Yeah.
they couldn't normally afford.
Right.
Like, or they bought some Egyptian sheets that were like $1,000.
Yeah.
Okay. And
Yeah.
they're like, well, see, I can't afford $1,000 for Egyptian sheets in
Yeah.
from my paycheck, but I can afford them over, the installment period of, 3 monthly payments of $300.
Yeah.
And that's how
Yeah.
I treat myself. And then in 3 months from now, I'll treat myself to something else.
Yeah,
And
yeah, exactly. It's a perfect example because in a lot of these situations, if they are small debts, by the time you actually address them in underwrite form, they may be paid off by the time the person gets to closing. So it's like,
yep,
I think that there needs to be a threshold, I think, as far as a dollar amount that makes sense. And I think there also just needs to be consideration of how many are active at one time. Because the
well,
rule right now in the book already says if you've got exactly. So if I think somebody put Cat Willis, most of them are under 10 months remaining. Right. So the handbook right now says that any installment loan under 10 months doesn't count within the DTI
right.
anyway. So it's like, well, if that's already on the books, these are clearly under 10 months. So do you even count it? So
Yeah.
kind of what we're pondering when I'm helping
I
with the
think it's the same thing as they were looking at trying to count like utility bills into credit and such. And I
right.
think that if they're going to do it, they have to give public notice at least a couple years in advance because like right now it's like, oh, I can let the PG&E bill go because no one's ever going to know and who cares
Right.
except PG&E and they're going to threaten to cut my electricity off, but I can buy some time and then I cannot. And so then I still get I pay my bill and then they're happy. But if you
Yep.
looked at my,
Yep.
history and they show, oh, look, he didn't pay it on time. He was late. Well, I still paid it.
Yeah.
And
Yep.
right now,
Yep.
I don't care if PG&E's mad at me.
So I
Yep.
just, when that was, they had a credit limit with one of those places up to $5,000 and they could pay over 24 months, which I had not seen before.
Hmm.
And also I think this ship is already sailing because Fannie's already said, or not Fannie, but they're the credit bureaus are yeah, Fannie. They're gonna wait, who? They're gonna show them on the credit report like shortly. Like there's no real ramp up time. We just talked about this. Anyway, so
Yeah.
somebody who's listened to me say this before said.
Yeah.
But yeah, so it's happening right now, that it looks like that is, and also the delinquency levels on those are astronomical. Like I think
Yeah.
the numbers we saw in the last few months have been, sometimes 40%, I think even up 45% of them were delinquent. So, to your point, you can have a whole
Really?
and and yes, really, Kevin. Um, were there when we talked about it. So
That's a high percentage rate of delinquencies on them.
okay, so Kat is saying they're already on the credit report that a firm reports only to
Yep, a firm does, yeah. And what I've seen is that typically the ones that have some level of interest, like a firm does have for their longer term, like, because I think that with their underwriting, they have two types. Like you can have one that is just like straight installments that are like coming directly as, from your checking account or whatever. And then they do have the ones that are longer term that have smaller payments, but they accrue interest on them. So a firm is one of those providers that actually charges interest. But let's say, for example, Klarna, like Klarna also offers just like a pay in four that does not charge interest. So I don't believe that those will show up on your credit report. But if you're approved for like interest over a longer period of time with, actual interest accruing, then those are the ones that will actually report. But there are the ones that are the shorter terms that are like 4 pays, $25. Those that don't charge interest, I don't believe that those are reported, but the ones that do charge interest from those providers are the ones that'll actually show up on the credit report. But somebody can fact check me on that if I'm wrong.
also, don't the conversation around PG&E and utility bills, that was happening back when they were talking about going to maybe a buy merge and incorporating Vantage and FICO 10T. And so that was probably when that was over 2 years ago that started popping up.
Mhm.
I have not
Yep.
heard that recently, so I don't think that's something they're going to do.
Yeah, no, I don't think they are either. But I did run into a client that had us voluntarily reported their utility bills on their,
Wow.
and they got turned down by one of the bigger banks because their debt ratios were too large because the bigger bank was including those payments in their ratios. Well, we all know as loan officers, well, you don't count the utility bills in the ratios. So I just backed them all out and I'm, oh, no, I got a 35 back end ratio. I'm great. And, did the loan. And they're like thinking I'm brilliant. And I'm like, all I did was just fix your credit report. I didn't do anything else. I didn't even change the credit report. I just pulled it off the application. That's all I had to do. Boom, done.
We've seen that with things where, and often the big banks, they'll go through somebody's bank statements, and if they see a recurring charge, like even pet insurance, they'll hit their DTI for it, and all of a sudden they might not qualify. So it's something that we have as an advantage over some of the loan officers at big banks. So it is so anyway, so it is just something to remember and be aware of. And again, if that conversation starts happening again, we'll let you know. We were all over it when they when they were first saying, okay, we're gonna make all these changes, the GSEs, and I'd sit on these. I was able to sit on a couple meetings with them as they're talking to lenders about incorporating all these changes into their systems, and the lenders, I mean, this was a few years ago, and they were just like deer in the headlights because they're downsizing like crazy. They have no income. They're not profitable. It's all going to HE double toothpicks. And the GSEs are like, hey, how about this? Do you have resources for this? And they're like,
No.
you know,
So, oh, I'm sorry, Audrey. Sorry.
no, go ahead. It's fine.
But I would absolutely, I would absolutely suggest though, whoever is interested in this to talk to whoever would be your voice at your particular shop to weigh in, because this is the first time that this administration is reaching out to get information about access to credit. Everything else has typically been more on the operational side. It's been more like, yes, you're talking about loss mit. This is the first time in the access to credit space that this particular administration is reaching out for input. And I think that this will be very telling about how engaged the industry will be with them, what they can basically expect. Like, okay, well, when we propose something, are people going to be engaged, or can we just kind of do what we want to do? And, nobody, we gave them the opportunity to talk to us before and we didn't get any responses back. So if you want to set the precedent of, ask us what we think, this is a perfect way to start the relationship, to say, we're listening to what you put out and we are paying attention to what you do. So this is kind of the litmus of what this relationship will be. So I would suggest that, every organization, whether you do it individually or if you, use a trade organization like, the NBA or ABA or whoever you want to sign on to in order to have that conversation, then make sure that you're represented there so they know that there's an active industry that wants to weigh in and has something to say. Somebody asked for the link. Kat, I can drop it. I'll find it and I can drop it for you.
You can just send it to me. They won't be able to see it in the chat. Don't ask me.
Got it. Okay. I'll send it to Audrey so Audrey can circulate it to you guys.
We'll just put it on the flyer for next week, and then they can click from there. It would
Or you can Google buy now, pay later RFI. If you do BNPL RFI, it'll pop right up in the federal. It's in the Federal Register too, you guys.
But if that seems too complicated, we'll just in case.
More alphabet soup, guys. BNPL RFI. We can make a song about that. You can make a jingle about that, Audrey.
Oh my God, we had the president of NAM on last week, and it's so funny because I was on the NAM board for a while, and they I kept telling him, I'm like, can you please put those calls to action on the front page, like like when you log in to nam.org, put it right there so they just go click and then they're done. And they still have no. The answer was no. No, and no. Let's make him like dive into somewhere in the website. Who the hell knows where it is? And it's so hard. So anyway,
Kat is our resident Siri. She found it and dropped the link in the chat.
Good.
Good job, Kat.
And with that being said, can you please also email it to me, because I am I sent Kevin a picture of how I have things set up where I am. It is a joke. If you saw how my laptop was on top of this, which is on top of that, with this other thing propping it up, and it's laughable. So I'm afraid to touch my keyboard right now and copy that. So,
you look wonderful, though. You look like your production is wonderful there across the pond.
Oh my gosh. Okay, so I put my glasses on and all of a sudden I look like I have a horrible sunburn and I can't figure out whether it's because there's burgundy on the lamps in front of I'm like, all right, forget it. Who cares? No one's here to look at me. Well, just I'm just gonna keep it moving. Um, okay, so I saw this unbelievable post on LinkedIn and it was from somebody I don't know, but I'm gonna give him credit here. His name is Marty Selleck. Okay. So Marty Selleck posted this on LinkedIn and I was horrified. And I thought I'd throw it by you because FHA was mentioned. So be aware that our clients are being solicited by complete Neanderthal horrible people. So actually Neanderthals actually have been found to be smart. So I take that back. By liars, connivers, cheaters, and bad people. Okay, moving right along. So
Okay,
the scenario. You ready for this? Just buckle
I'm
up.
ready.
It's ridiculous.
Okay.
So the customer was told they can have an interest rate of 5 7/8. Their original loan was $191,000 and their LTV was 73%. Okay? Let that sink in.
Okay.
So,
5.78 and you said 73% LTV?
yep, no MI, no nothing, right? Now we're
Okay,
going
so
to
this is okay.
new loan of $212,000 with a new LTV of 81%. Please note, once you go over 80, just for anyone on the call who isn't aware of this, even though you're in the business, that triggers
That mortgage insurance now.
yes.
Yeah.
Yeah.
But
But they still got their 5.99.
it's 5.5 and 7/8, Kevin. Pay attention.
Oh, 5 and 7/8, even better.
Hang on. So
Hey, some people, it's all about the rate.
I have to get
All about the rate.
yeah, exactly. So their total monthly savings, just to be clear, so they can at a dinner party say, I just got 5 and 7/8. Here's what it's cost them. You ready? Their total monthly savings will be $48.
Saw that.
It will take them 27 years to break even because closing costs are $18,397. They are going to be paying 3.383 in points. That'd be $7,194. But because now we're going to go from having a 73% LTV to having an FHA loan, you now are going to pay upfront MI of $36.57. They were told, the borrowers were told, don't worry, you're going to get a check for $4,000 in the mail. Now, just let's be clear, that was the refund from their current.
Fund for the minute.
That's the money they have now. They were also promised that we'll do an FHA streamline for you in a few months when the rates go down. And that'll be free. Don't worry about that. And also, because these people are also tax experts, they're going to get a huge tax write-off by paying the points. Yeah. So that's the kind of crap, and I am being so well behaved right now.
I am impressed at how judicious you're being with your language, Audrey. You're doing very well. You're
way better than you were before the show.
100%. I deserve that praise because in case you can't see it, because I'm in England, I have smoke rolling out of my ears because I am fuming. It is so much. And they're using FHA loans for this crap, Julienne. I mean, this is egregious to a point where these people should lose their licenses. I mean, maybe they don't even have a license. Who the hell knows? But I mean, can you believe that?
Yes. So what it sounds like is, so my wheels were turning because I feel like I saw this somewhere, but I don't know if I read it, but I saw this. So here's the thing. It's interesting because remember we used to do net tangible benefit, and this is something that I've always argued on a refi is a need for net tangible benefit. Like $48 a month is not enough of a savings, because I could have possibly made the argument if it was a cash out in a conventional, because if you went out at 81%, you'll be dropping off your MI in less than 6 months, right? So you would have dropped right back down in the conventional space because we know that the mortgage insurance will drop off. So if they went up to 81, they would have been under 80 in 15 minutes. But still,
they have to be under 78.
Well, but we're saying, but in FHA land, it's life of loan. So that absolutely doesn't make sense in order to save $48 to do that. So the only thing that I can imagine is if somebody was in one, they weren't credit strong, and that's the reason why they went FHA, because they don't have loan level pricing adjusters. Two, they absolutely needed the cash for some level of emergency. And that's the reason why they refied. The savings is 48, but they needed the cash more, but they might have been, I'm just playing devil's advocate. If
Yeah,
that is the only way that this would make sense is I need to buy a new car. I don't have any cash for down payment. I have poor credit, and FHA was the only way that I could get approved. And yes, my payment's going down $48, but I was able to pull out $25,000 in cash and I needed to buy a car. That is the only way that that would absolutely make sense. But if somebody, like you said, is just reaching out and this is just a predatory, let me see if I can refi somebody and just get new volume for my commission, absolutely, that's trashy.
Cost
Absolutely.
less.
wait. I mean, volume for your commissions, that's not a good thing?
It would cost less to do a loan with Guido. Do not.
Yeah.
It's
The
so
cost to do it for the actual lender would be to service it and set it back up wouldn't even be worth it. I mean, it's because you then basically you only get paid commission on new money anyway. So it's not like
that is some
anyway.
pure garbage, LO. And if you're on this call, you should fire yourself. They're not on this call.
They're
Nobody
not on this call.
this call.
No, we are the white hats here. We are the ones that are the do-gooders who assist the community. And Catherine, yes, you're right. That is the right RFI. I'm sorry, I see it in the chat. You're right.
And Kevin, I was not going to let you finish your sentence because I had to like scream what I needed to scream. So what were you about to say?
I love this dynamic of you and Kevin. Y'all are just like, you are just perfect. I'm telling you, I love this. I missed you guys so much. This is so great.
I miss you too. Oh my God. Okay, so
I can get a word in edgewise. That's my only challenge half the time.
you say plenty. Oh my God. Okay, people are now following you on LinkedIn, Julienne, so that's good.
I love it.
I know. Okay, I thought this was interesting. You ready? Okay, average closing costs with recording and taxes per state. Ready? Okay, so California, 6 grand. I think that's a little light. What do you think, Kevin?
Yeah, you said 6%. You said 6,000
Yeah,
$1,000.
that's
for
Okay.
all of the
okay,
closing
but
costs?
you gotta throw in Fresno in there. See, Fresno pulls it down, San Francisco pulls it up. It just like
Did
I
they
just
finance a
somebody
doghouse? Is this a doghouse that we're talking about? This is an actual house for 6 grand?
Okay.
I just quoted someone this morning for a $1.4 million loan. Yeah, well, it's at 2 points. That's $28,000. And
I
I'm
mean,
like,
about
it is what it is. And they're
oh,
like, yeah, okay. Oh, but then there's a payments, 2 payments. Yeah, they're about 12,000 a month. Okay. So we're talking about 50 grand total. Yeah, about 50. He goes, oh, that sounds reasonable
I'm
for a
just
two
still
month
on
loan.
6,000. I'm like, a Barbie playhouse? Is this somewhere in the metaverse? Like not a real house that we all can occupy?
This is
There's
a
no
real
way.
house, a real house. $1.4 million, 5 bedrooms. It's 3 baths. It's a nice house.
I'm talking
It's
about this
popular if
6,000
anyone
that
knows about
Audrey is
architecture.
Kevin, I'm talking about this 6,000 that Audrey is talking about these closing costs for 6,000 in California, because that can't get you can't pay closing costs on the doormat of a house in California for $6,000.
this is from realtor.com, just for the
Well,
record.
I don't know. That sounds a little dicey.
You think so?
I want to see them put that on the initial estimate in the beginning. Put that on the closing cost estimate and not update it before closing and give it to them 3 days before closing and see if you're gonna bump it up. Maybe it's a zero.
You know why you're objecting so strongly? Because in DC, you're at 18 grand. $18,000.
And I don't even believe that. I think 18 is still low in DC. That is, it doesn't even sound right.
So it depends on whether they're paying points or not. That is valid. I mean, really, 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 really super valid.
yeah.
So let's assume these are no point loans, okay, people? But I don't understand what I was curious about for anyone who's listening from like, okay, where's a good state? Here, a lot of them are 3,000. Kansas, 2 grand to close a mortgage.
I don't believe this. This can't
Okay.
be right.
That's just a
I'm
couple
serious.
escrow payments.
This is the closing cost on the doorbell of these houses. This cannot be. This is for the driveway. This is closing costs on the driveway. It cannot be for the actual land and the structure. I can't.
My driveway in like 23 years ago. Let me tell you something. It was so bloody expensive. We should have like rented out burial space underneath so that we could have had some sort of like compensation for that. So yeah, okay. Realtor.com thinks that closing costs are all over the place. And I thought that was
They need to hire me. Like, it sounds like they need me to provide some consulting, because these numbers are going to have people set up coming to closing and not being able to finish.
okay. Well, there you go.
Wow.
And by the way, again, they're including recording fees and taxes. And by the way, they're trying to bump up the recording fees again in California, which is the dumbest thing I've ever heard of. I had to sit through a meeting where someone promote this and keep my mouth shut, which was, I mean, I needed medication. It was really, really hard. So
I just can't get over this. I don't know anything you can buy in California for $6,000, including closing costs. I'm just in here. I don't know what I could buy in California for. Well, I do know something you can buy in California, but $6,000, that's wild.
I think Audrey can get a full tank of gas with 6,000.
yeah, exactly.
It's just wild.
So it-
6,000.
In other in other nerds, of which probably
I
most.
mean, is this cryptocurrency? Is it 6,000 in crypto? Like, I'm sorry. Is it Bitcoin? I'm just sorry. Okay, I digress. Go ahead, Audrey. I'm sorry.
At that for a minute, because Fannie and Freddie are now going to acknowledge it, accept it, act like it's real. I mean, the whole bit. So do you have any ideas? FHA going to follow suit?
I can't speak on anything that will happen currently at HUD. I will just say, if history serves as anything, FHA is typically last on anything in advancing technology.
Wait, they're going to be last. Oh yeah.
I'd say they're going to be. I would just say, if history serves as any indicator,
They're still
we are
using
typically
DOS, aren't they?
we're typically last in joining trends. And the reason why I say that is because FHA borrowers are typically the most vulnerable to any change in market. So if we do decide to, well, I'm saying we, because FHA is in my heart, HUD is still in my heart. But if the program makes any type of change, the implications on those borrowers are more consequential, because they have fewer resources and things like that. So, doing any swing in policy or accepting things usually has to go through some serious stress testing, because FHA borrowers just can't afford, like, you can't afford to be wrong with FHA borrowers when you're doing anything in policy. So I hope that they still adopt that. Like, we just can't do trends over at FHA, because people will get hurt and they can't recover as fast. That's just the fact.
Let's see how that goes, shall we?
Hey, well, we have like a minute left here.
We do not.
5. We got time. But I wanted to share the story of my client that I shared with Audrey before the show. So I have a client, I'm not going to say male or female, who works for a major corporation that we all probably use.
He works for a company.
Yeah, works for a company, yeah. And this company has decided they're going to get into the mortgage business with AI. And he is I said he, but anyhow, could be a she, is one of the designers to the AI programs. And he keeps telling me through this whole loan process how stupid the underwriters are, how stupid everybody is involved in the transaction, and how AI is going to take care of all of these things. And the whole time through this transaction, I'm thinking this deal would never happen if I didn't just hound and push and convince this guy to keep moving forward and do the things he's supposed to do, like get me the updated pay stubs on a timely basis, sign the CD the day it's issued and not wait a day, which he's done for every document all along the way. And oh, wait a minute, he did it again, yet again. The CD went out yesterday. When did he sign it? This morning. I'm like, okay, well, now we're closing a day later. And it's like, there is no way AI could have gotten this client to close.
No way.
There's just no way. And the crazy part was, at the last second, we were ready to close, the underwriter came out and said, I'm ready to close, and the underwriters, we can't do the deal because we don't calculate the income the way you originally did it, and we're going to deny the loan. And this is, when I'm supposed to be closing. Now, fortunately, I was able to flip lenders, get it ready to close, and 10 days later with another lender who totally viewed the income the way I did it, and now we're closing. And it's just so like, oh, well, AI can do all this stuff. And I'm just like, yeah, I don't think so.
You
Every
can't
time
substitute lived experience. I mean,
No.
Well, and then the other thing too is every time he tells me about this loan, I'm like, there's no way this is closing if you're not there just pounding it. And also that like we can have a conversation and then here's another idea, here's another way to do it, here's another, right? It's all this blending of the minds that is so important for all of us. Like we have
Mhm.
to pick up the phone, talk about these situations with. It is unbelievable how much of that goes into what we do. And then the fact that he could pivot and send it to another lender and figure out a plan B.
yeah,
Telling me that your little computer system is going to
that's
just,
your little computer.
I mean, give me a freaking break. Anyway, and this,
But yeah.
and oh my God, arrogant.
But think about how many times we've had to, I mean, we're in the support group.
Yep.
How many times have you had to literally argue down an underwriter about something because, one way that it could be interpreted is this, but then as soon as you take the argument and say, hey, look, but what about this? I mean, that there's a lot of creativity. I'm from the school where we used to read the rate sheet. Like the rate sheet would come out and they would slide it under your door. You know what I mean?
Mhm.
And we would have
Yep.
to price it like what is par and overage, and we're taking this short. Like I had to read an actual Xeroxed rate sheet back in the day. Like
I mean,
there's a
fact
part
sheet.
of your, it's crazy. So there's a part of your brain that LOs have that you have to like, you can't plug that in. Like there's just, sometimes it's a gut. Sometimes you're like, you know what? I'm gonna throw it against the wall and see if it sticks. And sometimes it does. So yeah, I mean, look, you
Do you
cannot,
remember?
go ahead.
I don't know if your office had it, but we used to get all the fact sheets every day of all the different lenders, and they would have this sheet on this tab on the desktop, and every rate sheet would be organized by alphabet. So
Yeah.
countrywide into the C's, okay. And I remember this one new loan officer sitting there staring at it, and she's like, "Oh my God, this is so hard. How do I figure out which lender to go to?" I go, "Well, what's the last name of your borrower?" They're like, "Sullivan." I go, "Okay, flip the S. Those are all your lenders that you can use for the Sullivans."
Well, that's one way to do it. Well, the first time when somebody said to me, we got a pricing engine, I was like, that was our AI. When we got a
Oh
pricing,
yeah, that
we
was
have a
whew.
pricing engine. I was like, whoa, don't trust that. You know what I mean?
When I first started, they didn't even have faxed rate sheets. We had people delivering credit
Yeah,
reports. Super high tech.
yes.
Delivering.
Manila folders, like
Well,
literally.
how about our guest last week would take the credit report over the phone and write it all down?
Oh,
Yes, people would get. That's right.
Yep.
That's
crazy.
right.
Okay, really quick. I just want to run through this really quick. So just, got this from MBS Highway. They were talking about the delinquencies because the headlines are delinquencies are up, right? So, oh, scare the crap out of everyone. The sky's falling. We're going to have a meltdown. Just, okay, so here's where we are. Vantage score. The 30 to 59-day delinquencies rose from 0.95 to 1.101, 1.01. So very slight, which by the way is the same as it was 2 months ago. And 3 to 4 months ago, it was even higher, and it's about been like right where it is most of this year. 60 to 89-day delinquencies are the second best of the past year, and 90 plus delinquencies fell significantly. And
Yep.
those, so again, when you're seeing the headlines saying, oh my God, your clients are going to see them, scares the crap out of them. And then they think, oh my God, I'll just wait and buy a house in a fire sale. And that's not happening. So, and with,
No. Yeah. Can
with
I share with you something, Audrey, that before you keep going? Like when we were looking at SDQs, seriously delinquent, when we were doing loss mitigation stuff, we looked at the behavior of people and it supported exactly what you're saying. Like a lot of people will do the round robin, like this month I'll pay this, next month I'll pay this set of bills, and then the third month I'll swing back to the one that I paid the first, before. So there's like, what am I going to pay this month? So it'll be like, okay, well, I'm going to pay the car this month. I'm not going to pay it next month, but then the third month before I hit 90 days, I'm going to pay my car. So that's why you'll see people go up to the line and then will never really cross over 90 because they'll skip a month of payments and then swing back and catch it. So that's why we never really see that many people go 91 days or delinquent. They're doing the round robin, which not to say that that's good, but it's usually strategic that people will pay, skip a month, pay, skip a month. And that's why we saw with the SDQs, that people would be delinquent, but they would never tip over into SDQ to be 91 days. They would always stop at like day 89. That's what we were seeing when I was there.
That makes sense because I had somebody say to me recently, "Oh, it doesn't show in your credit report till it's 90 days, right?" There's so much misinformation out there and they think
Yeah.
things. This was a bright, intelligent person. So if she thinks that, then who God knows. I didn't know that about
Maybe they're getting the information from X.
thank
Yeah.
you for sharing. I also wanted to mention briefly that PCE, which is the Fed's favorite measure of inflation, came out for May. The headline was right within expectations. Core was expected to be at 0.1. It came in at 0.2. It was a little, there were upward revisions to April, which wasn't great. But really, if you look at the core 6-month run rate, it's gone from 2.9% to 2.7%, and in February is 3.4%, and the 3-month run rate was 4.2% in February, and it came down from 2.8% to 1.6%. So we are getting there. Appreciation is still solid. Things are still solid in our industry. It's interesting because it's very regional or very specific to where you are, so make sure you're checking that out. But we should be closing loans. So go get a loan this week and I want you to close it. And Julian, we love you. And it is so good to have you back.
Thanks, guys. This was awesome. This was awesome, awesome, awesome. What I will say again, Audrey, before we go, please, please, please make your voices heard. Please be proactive about the things that you like, because this is a brand new relationship. So if you got a restaurant that you loved and it's under new management and you love the chicken or the fish that's on the menu, you need to say, hey, look, we love the chicken and the fish. Please don't take it off the menu. So if there are particular policies that have been helpful for you, it is great for you to be proactive and say, hey, look, I know that you guys are in a season of reform, but this has been really helpful. And to be proactive that way can save a whole lot of heartache and heartburn for everybody. So check me out on LinkedIn, guys.
Definitely
Please.
check you out. We have some thank yous coming into the chat, so thank you.
And
Very
somebody showed love to Phoenix, my Yorkie back there. So somebody, thank you, Jill. That's my baby Phoenix. He's a Yorkie. Thanks.
chat too.
Oh no, the Phoenix is coming back. He's over my shoulder. He wants his cameo, but he's behind me. Hi,
Exactly.
baby.
Well, I wasn't able to count the number of relatives who popped into that door, but we did all right. Glad
I think they all came in. I think I saw all of them.
it wasn't all of them. I promise you that. All right. Have a great week, guys. Go close some loans. Bye.
Bye, everybody.